Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com comments on the equity markets gaining 24% so far this year and how gold has shared that success. John Rubino, author of several books on the economy, warns the U.S. government has been so busy playing politics, it has ignored important economic action, including getting the new NAFTA agreement ratified and dealing with the U.S. debt. WolfStreet.com publisher Wolf Richter gives us the latest on the new and used auto markets and also tells us why the Swiss National Bank is busy buying U.S. equities, even shares that are losers. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Always good to be with you, Jim.
Ross, just before we get rolling here, Charts and Markets has a special year-end deal. Can you tell us about it?
Yes, we're offering the full research package, which would be my analysis, mostly technical, along with Bob Hoy's commentaries and his weekly pivotal events, for $60 for all reports through the end of the year. So it's the type of thing that we would like people to see the material that we put out, and hopefully they enjoy it enough that they come out for a full subscription later on.
And as we're going to talk about, Ross, usually November's your best month in the stock market, so you better be picking the right stuff.
Well, you better be in. That's the key. Typically you're going to have a correction sometime in September through November, and in most cases we look for an oversold reading sometime in that October-November window, and in like 7 out of the last dozen years, or dozen presidential cycles, which is one of the things we do sort of narrow this down to, is that if you get that oversold in October through early November, and in our case we had it in the first week of October, if you can manage to break out, which it does basically about 3/4 of the time, then you'll see prices run. And so as of the end of this week, it's 16 days now since the S&P broke out above the summer highs. Not the all-time highs, but above the summer highs. Because what you want to see is a good clean out and then a breakout through resistance. And once that's in place, you can start to make some measurements. So in the case of the S&P, 16 days since the breakout, the average run here is 32 to 37 days. So we are only now approaching the halfway point of what should be the run into the tail end of the year. Historically, once you've got that first run behind you, you'd expect to see a bit of a correction, and then the stretch right around the end of the year, the last couple of weeks of December into that first week of January, historically is another one of those really positive windows. Now, last year, there was a pretty hard correction into, was it Christmas Eve, the 24th of December. And markets then did exceptionally well after that. So, what we'll be watching for is some overbought readings, probably maybe in another 3 weeks or so, a pullback, and then a run into the end of the year. For traders, that could present a few opportunities, and for longer-term investors, as we hit that window early January, it might be a time to really start locking in some profits. And you want to be doing it into New Year's so that you're not, you're defraying any of your capital gains for another year.
Gold, has it kept pace with the stock market?
Well, in the inverse fashion, as you would anticipate, with the risk-on attitude that you're seeing in terms of the equity markets, the safe havens, gold, silver, and the bond market, at least the treasury bond market, which had done exceptionally well up until the middle of the summer, they are having very reasonable corrections at this point. So when we take a look at the big picture, you take a look at that 5-year base that gold had, and you measure the depth of that base and the breakout that we had out through that 1350, 1360 range. You take the height of the base, measure up 38% of that, and then maybe another 62%, the Fibonacci numbers. You get a series of upside objectives. In this case, the September high was right on the money. And when you look at similar patterns, and we go back, and look at this over decades, the breakout in 1978 measured into the 870s, and we hit 900. The breakout in 2006 measured up to the 700 level, and had a big correction. This measurement out of the base, this 5-year base, was right up to targets that were hit in September. And the piece that we put out earlier in the week showed that the corrective process that we're in now, we would expect that one to pull back into either the 1430 range or around 1400. We'll be looking for some oversold conditions against some important weekly moving averages. And if that comes into play the way it has in the past, then next major target on the upside is going to be just shy of 1900. The measurement is 1888. So we're really looking forward to the next month or so here to present a very significant opportunity for both the bullion and the miners, because looking back at not only the recent history of the HUI or the GDX indexes, but looking at the Barron's Gold Mining Index going back all the way into the 70s, the type of break that we're having in here is what we'd expect after you've hit a Fibonacci target, and these have got some very consistent support levels when we look back at them. And as I say, the potential coming out of this low could be a pretty big number.
Ross, again, for somebody interested in your year-end special, where do they go?
Well, they go to chartsandmarkets.com, and right up there on the home page, there's a link to subscriptions.
Ross, thanks for being on This Week in Money.
Glad to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, John Rubino, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble. His website, dollarcollapse.com. Welcome back to This Week in Money, John.
Hey, Jim. Good to be back.
John, have the impeachment hearings and investigations and so on in Washington, D.C. really muddled up and disengaged the U.S. government from what it should really be doing, looking after the lives and business affairs of American citizens?
You know, this has become the new normal in the U.S. It's been going on for 3 years, where basically pretty much all the government does is battle over, first it was the Russiagate investigation, which was, was a very big charge. That was a serious thing. And it turned out to be nothing. But it took us 2 years and millions of dollars and government gridlock that whole time to get there. And then as soon as that ended, the Democrats, who basically are, you've heard the term Trump derangement syndrome, and they're basically in the throes of something like that, where they need him out of there, and they can't wait for the election. They need him out of here now, and so they're coming up with something that, compared to, accusing him of being a Russian agent and stealing the election, is so minuscule and so hard to understand for the average person, and they're staking everything on that. Whether Trump asked the Ukrainian government to investigate whether Joe Biden was corrupt within the Ukraine and threatened to withhold military aid as part of a quid pro quo. That's the big word now, quid pro quo. And, nobody even understands what any of that means. And there's a transcript of a conversation out that really, I think if the average American listens to it, the response is, wow, Trump says 10 things in every press conference that are worse than whatever it was he said there. And I don't even understand what he said there. So, yeah, the Democrats are just flaming out here. They are just crashing and burning in Congress. Meanwhile, the presidential campaign is in full swing. And you know what? The Democrat presidential candidates really hardly ever mention impeachment. It's just, it's something that's going on within the sitting government. And the aspiring presidents don't seem to care much about it, thank God. Otherwise, we'd have to listen to them talk about it too. But the election is exposing kind of a civil war within the left in the U.S. You got the kind of the mainstream Clinton, Biden, corporatist, business as usual left, and who are really moderates. And then you've got the fairly extreme out front socialist left, and those two groups do not get along at all. But somehow they have to pick a single presidential candidate, and then everybody get behind that candidate. So it's not clear that that's even possible, but it's really fun to watch. This is political theater. If it wasn't for the, nuclear weapons and environmental degradation and ever-increasing debt, this would be really fun to watch. But unfortunately, it's all taking place on a stage of extreme problems, and nobody's doing anything about it, really. So we're, as I say, whenever I come on your show, I say we're heading off a cliff, and we really are. We are just barreling towards the abyss right now financially. And as an example of that, the U.S. government just had a record month of borrowing in its most recent reporting month. I guess that was October. It was the biggest October for the deficit in, almost a record level. Since the Great Recession, since we were running $1.5 trillion deficits, when we were in the worst downturn since the Great Depression. Now we're 10 years into an expansion, and our deficits are almost as large as they were back in, what was a generational crisis. So we haven't learned any lessons at all. And we're making things worse. And a lot of that is because politics is so tied up in knots right now. It's just left all of these dysfunctional systems on autopilot, where they borrow more and more money each year. And the Fed accommodates this extreme borrowing with lower and lower interest rates each year. And we'll do that until it doesn't work anymore. And when it doesn't work, we'll have nothing left. And the system will just spin out of control. So timing, Jim. It's just a question of when this happens, but it's clear that we're headed that way, and there's nothing on the political side of the ledger that implies that we have any plan for stopping it or fixing it.
Well, on the money side of things, the world's biggest trading partnership, Canada and the U.S. government has yet to ratify the negotiated NAFTA 2 deal. How's that going to affect an economy where goods are shipped back and forth across the border several times?
Well, yeah, that's a good example of our government having things it could do, but just not doing it. We cut the deal with Canada, and so all the Congress has to do is sign off on it, right? And then the deal is in place, and we can go back to effectively free trade between our two countries. And we're just not doing that. So I have no idea what kind of disruptions that's causing. I hope it's not too serious because, as you said, you are our biggest trading partner. we should be taking care of you. And we're really not. And there's a long list of things like that, though, that we could be doing right now. If we had the kind of government where the president and the legislative branch could sit down together and work out compromises where everybody gets something but nobody gets everything, and then put those compromises in place, we would at least be accomplishing something. We might be able to slow down the institutional momentum towards that financial abyss. But we're way past the point now where that's even possible. And the only way that anything really gets done is when one government completely controls, or one party completely controls the government. Both branches of the legislature and the executive branch, and that's very, very rare. It usually happens for 1 or 2 years at the beginning of a presidential term. And then the midterm elections kick out half of the president's party in Congress and it goes back to being controlled by the other party. And then you get gridlock until the cycle repeats. So it depends on what happens in the coming election, of course, but it's highly unlikely that the Republicans or the Democrats end up in charge of the whole government in 2020, which means this isn't going to end. We're just going to have political chaos forever. And it's not just the U.S., of course. The rest of the world seems to be spinning out of control right now. If you Google civil unrest, and you get some serious stuff that a lot of people don't even really hear about. I mean, Ecuador just had a coup where their democratically elected president had to leave before the military killed him. In Iraq, which is supposed to be our success story in the Middle East, there are huge public protests which the government soldiers are shooting into and killing lots of people. And Hong Kong, of course, is nonstop civil unrest. And France still has the yellow vest protesters out in the streets. And Chile, which is supposed to be the Latin American success story, you never hear about Chile because they're this basically middle-class country, we thought, that just went about its business and mined its copper and sent its fishing fleets out and basically made its money, and that was it. We thought they were a success story, and instead they're in a state of emergency because of rising inequality that apparently that the people just got so frustrated with that they took to the streets. It goes on and on. And the reason that it's happening now can be traced back to the debt that is growing globally continuously. We basically doubled global debt in the last 10 years when we were in the throes of a crisis that was caused by excessive debt. So instead of learning our lesson in, for instance, 2000 when the tech bubble burst, or in 2008 when we had the banking collapse and the Great Recession start, which was that we need to get our financial houses in order all around the world. We did the opposite. We just borrowed more money to get ourselves out of the immediate problem, which is kind of similar to taking a double dose of opioids because your back is sore, right? Instead of doing the exercises or getting the operation or whatever to fix your back, you just pop ever larger amounts of opioids in the hope that pain just goes away eventually. And it doesn't, usually. That's not how it works in life. And that's definitely not how it works in finance. You can't wish away debt. Debt can only be gotten rid of in basically two ways. You default on it. And when that happens society-wide, that means you have a very big, very nasty depression. Or you lower the value of your currency to make the debt easier to manage because you pay it back in cheaper money. And that is an inflation or a hyperinflation, depending on how far you have to cut the value of your currency. And that's incredibly painful and disruptive. And that's basically it. You have those two choices. So there we are, and the fact that we're not doing anything to deal with any of this means that inequality continues to rise and life gets harder for average people while it gets easier for the rich. And it takes a lot of societies to the breaking point, where as Gerald Celente, a commentator who is a big trend analyzer, likes to say when people have nothing left to lose, they lose it. And that's where we are in the world. Now, luckily, Canada doesn't seem to be having that problem yet. You guys are just very nice, and you have a ton of land. And, you're incredibly rich per capita in natural resources. And so you don't seem to suffer through a lot of the problems that these overcrowded, overtaxed places do around the world. But don't get cocky. If the U.S. goes and China goes and France and Germany have civil unrest, you will too. So you are not immune to the problems of the rest of the world, even though you are less susceptible to them, apparently.
Well, don't forget here, we just had a federal election with Trudeau reelected with a minority government. He gained no seats whatsoever in Saskatchewan and Alberta. They all voted Conservative, and they're feeling pretty put out that very little attention is being paid to them by the federal government when it comes to the job losses they've suffered in the oil patch. So it's not all incredibly smooth in Canada either.
Well, no, but you know what? You're not killing anybody yet, right?
No.
So that's you have the advantage over most of the rest of the world right now. But yeah, a resource-based economy is inherently a cyclical economy. And that's what you've got to deal with in the future. If we, a lot of people are calling for a new raw materials bull market. So if that happens, like if oil and iron ore and copper and gold and silver, among other things, go up in price in the next few years, you guys will be maybe the main beneficiary in the world of that trend. So we can hope, right?
We'll have more with John Rubino when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Rubino. John, what's your outlook for gold and silver?
I think the outlook for gold and silver is always good in this environment because we're always taking on more and more debt around the world, not just the U.S., not just Canada, but all of Europe. Most of Asia, big chunk of Latin America, are all borrowing too much money. And historically, what happens when governments borrow too much money is that they try to get out from under it by devaluing their currencies. And they can create as many new dollars and euros and yen as they want to bring that about. But what they can't create more of is gold and silver. You have to dig that out of the ground. And historically, we get about 2% more each year. Which means if the global money supply is growing by 5 or 10% in an attempt to generate global inflation, and gold and silver supply are only growing by 2%, the gap between paper and precious metals grows continuously, which means that the value of precious metals relative to these paper currencies that are being aggressively inflated away should go up over time. Now, that's not necessarily true in any given year. But over time, it's emphatically true. I mean, gold was $35 an ounce in 1971. And then it was $800 an ounce in 1980. And then it went down for a decade to $200 and some dollars an ounce. And since that time, it has been going up most of the time. And now it's going on $1,500 US dollars. So from $200 and some dollars in 2000 to $1,500-ish right now. That's a nice trend versus the dollar. So another way of saying that is that the U.S. dollar has been going down pretty consistently against gold ever since we went off the gold standard in 1971. And that means gold's doing its job of preserving wealth. You put some money in something like gold, which is a real form of money that governments can't inflate away, and you would expect it to hold its purchasing power. In other words, the wealth that you put into it should still be there when you want to take that wealth back out and spend it. And that is how it's worked with gold and mostly for silver. Now, there's a period towards the end of cycles, though, when precious metals go parabolic. In other words, when they just basically go straight up, because the financial troubles that accumulate as an expansion goes onward, especially a debt-driven expansion like the last few have been, start to generate inflation, start to spook people out of financial assets. And they start looking around for real things to put their money into. They find gold and silver as two of the things on the list of real things that you want to buy when you're worried about your money. And they pile into what are basically small, thin markets relative to stocks, bonds, and real estate. And so they send the price of gold and silver up dramatically for a little while. You know, from 2009 to 2011, gold effectively doubled. And in the 1970s, it did more than effectively double. So we could see something like that again, where gold doesn't just preserve purchasing power. It makes you a lot of money for a while. You know, the preserving purchasing power thing is over long periods of time. Like if you look at any 3-decade stretch, pretty much, with gold and silver, you can say, yeah, they held their value relative to real stuff. But there are stretches when you can look at them and say, wow, they quadrupled relative to real stuff. And I think we're in the part of the cycle when that frequently happens. So we could have a good few years in gold and silver, which, it shouldn't change your opinion about what it's for. It's basically money. It replaces dollars under the mattress or in your bank account. But it will, for a while, behave like a growth stock or something, where it goes up more than most other things do. And that's a nice period to be in precious metals, because you get what you want from them, which is a preservation of purchasing power, but you get more too. You get some alpha on top of it, some extra return over and above what you expected.
Is this a time to get into averaging, buying a certain amount of dollars into gold or silver every month?
Well, in this world, that's what you should always be doing. And starting in the 1970s, that would have been a wise way to approach precious metals. And that's never changed, because you can't know what's going to do in the next 6 months or next year. It could go down. It could go up. You can't know that. But if you buy the same dollar amount per month, then when it goes down, you end up buying more of it because you're putting the same number of dollars into it. And when it goes up, you buy less of it because you're putting the same dollars into something that's more expensive. And so over time, your average price is pretty favorable. And then you just keep on doing that until the system resolves itself in some way, which is to say, until we have our big crisis, whatever it's going to be, and we put in place a monetary system that has a chance to be sustainable going forward, which I would say it's probably going to have to be some kind of a gold standard. That's the only thing that's really worked in human history. So we'll have to go back to something like the classical gold standard of the 19th century, basically, where a government accumulates some gold, puts it in a vault, and then issues money that is some multiple of the gold that they've got in their vault. Say they issue twice as many dollars as the dollar value of gold that they've got stored, but no more. And that controls their money supply. And you can exchange your dollars for gold at any time, and that's what keeps governments under control, because if they start to issue too many dollars, people just turn them in for gold, government loses all their gold, and their money supply has to shrink because they're keeping a ratio of money to gold. And if we did that, then the money supply would be fairly stable, inflation would be non-existent, interest rates would be extremely low, and most debt would be taken on for productive uses only, because you wouldn't have the expectation of having your debts inflated away by a profligate government somewhere out there in the future. So you need to be careful about your borrowing. That was the world for really 200 years prior to World War I. And I think we have to, at some point, we're going to have to admit that the paper money experiment was a failure, and we'll have to go back to some kind of a constrained monetary system. And if we did that with gold, it would have to be at a really high gold price to make it possible to go back to the same ratio of paper to dollar value of gold out there in the world, which is to say we'd have to have like $10,000 an ounce gold. Now that's called a monetary reset. You hear that term a lot. And the people who have run those numbers, like James Turk and Jim Rickards, say that you would need about $10,000 an ounce to make this work for gold. So if we were to do something like the monetary reset that takes us back to something like the classical gold standard, you'd make a lot of money in gold going forward. Of course, we can't know when that's going to happen. We can't know what happens in between now and then. So that's the dollar cost averaging thesis. You know, you just don't try and predict where it's going in the short run. Just this month, take $500 and go buy some gold. Next month, do the same thing. Just build that into your budget. And then, you know, buy a lot of silver, of course, too. When I say gold, I mean gold and silver. And then don't think about this stuff. Just let it accumulate and get on with your life. And you're doing most of what you need to do financially right there. So it's a fairly simple way to approach a very complex, scary world.
What about countries like China and Russia that have been snapping up every chunk of gold they can find for the last 7 or 8 years?
Yeah, they seem to get this, you know, they see where the world is going. Plus they have another incentive, which is that they don't like the power that the U.S. has as the country that has the world's reserve currency. That gives us the ability to push everybody else around, including Russia and China, and they don't like that. So they see accumulating gold as a way of insulating their monetary systems from the threat that is represented by the U.S. dollar in the world. And they might also see it as as giving them an option in the future to go to a gold-backed currency if they want to, before we do. Say if Russia and China created some kind of a gold-backed currency that was either, you know, shared or separate, you know, each country did it or they did it together, that would be a significant threat to the U.S. dollar's dominance in the world financial system. And it might not be doable yet, but the more gold that Russia and China accumulate, the closer they get to that point where it's feasible for them. And, you know, they might not intend to do that because that brings a lot of issues with it when you try to do something like that. But they may like the idea of having the option. So they're accumulating gold for all the reasons we just talked about and for geopolitical reasons. And I got to say, they look very smart to do it, even just in capital gains terms right now. You know, the gold they bought over the past 15, 20 years is more valuable than the money they put into it in the first place. So they've got a nice capital gain on their balance sheet now based on all the gold that they've bought. So that alone made it a good idea, but it also gives them a lot of options in global finance that they wouldn't have otherwise. And I think it would be wise for us to emulate them rather than these big Western governments that just borrow money year after year after year and assume that everybody's going to want their currency no matter how they overinflate the supply of that currency. Because that's the kind of, that's a hope. That's not an expectation, really. That's just something you hope will happen when you don't really understand what you're doing and you want to avoid the consequences of stuff you might be doing wrong. You know, you hope that the dollar will always be valuable and that the euro will always be a semi-reserve currency, no matter what India or Italy and France and Spain and Portugal do with their budgets, you know, and same thing in the U.S. Now we're going to run record government deficits forever, you know, and encourage the corporate sector and the consumer sector and basically everybody else here to borrow as much as possible. And we're going to expect and hope that the dollar stays valuable through all that. And I think that's not the kind of thing you want to bet the farm on. It's possible that the dollar does hold up for quite a while longer, but it's also possible it doesn't, because it shouldn't, based on the mistakes we're making. So now, I look at China and Russia, and they seem a lot smarter at least about the gold issue than we do.
Now, what about countries like Britain and Canada that have essentially sold off all of their gold reserves? Is there a plan to either, seize the gold of private citizens to back their currency if that's necessary? It did happen back in the 30s in the States.
That's right. We did that. So you can't say it's not possible, because within living memory, the U.S. did something like that. So, and governments historically do crazy stuff when they get really desperate. When they start to go broke, all bets are off. They will do anything to get the money they need to stay in power for a little while longer. And if it means making gold bullion ownership illegal and requiring everybody to turn their gold bullion over to the government, again, that could totally happen. So in that circumstance, you deal with that in a few ways. One is by storing some of your gold overseas where the U.S. government or the Canadian government can't get to it. Another is by buying semi-collectible coins that you can call your coin collection that probably won't be taken away from you and melted down by the government, as opposed to just bullion coins, which are just gold and nothing else. And the third is you buy more silver than gold, because silver is an industrial metal, and the government couldn't possibly make silver ownership illegal, and it couldn't take away silver bullion when hundreds or thousands of companies out there are buying silver all the time to use in their microchips and in their clothing and all kinds of other things. And yet silver will still go up in value along with gold as all of this progresses. So you do all of those things, add some collectible gold coins, move some gold overseas, buy a lot of silver, and you basically are okay when a confiscation comes. And then you have to decide whether to obey the government or be a criminal in this case. And in the U.S., most people didn't give up their gold coins. The government got a small minority of the gold coins that were outstanding, because most people just shut up about it. Didn't say anything, didn't tell anybody they had gold coins, and the gold coins survived. I think the same thing would happen again today. There are all kinds of ways to hide gold coins. And unless we created an entire police force, like an army of people with metal detectors, and even then, God, can you imagine trying to find gold coins in people's backyards where there are nails and old pieces of stuff from the house that was there before and little bits of kid toys and things? You couldn't do it. So that would be a really bad idea for a government to try. However, governments try all kinds of bad ideas when they get desperate. So you definitely want to build that into your plan, build that possibility into your plan by diversifying.
Well, governments, do you believe, are against cash because they want everything to be electric so they can tax it? Tax every transaction.
The war on cash is sort of a preliminary battle in the war on real money. Because to have negative interest rates, they need to get rid of cash, because otherwise everybody will just pull their cash out of the bank and keep it at home. If the bank is going to charge them to hold cash, then you just break your relationship with your bank, and the banking system spins out of control. So you can't have negative interest rates on a sustained basis and still a robust cash sector in your economy. So they need to get rid of cash. And once they've gotten rid of cash and they're free to inflate away their currencies at will, then the value of gold starts going through the roof. Everybody wants gold. They try to turn their dollars and euros and yen into gold as quickly as possible, and that's disruptive. So then the government has to do something else. What will they do? That's the question. Now, hopefully they're smart enough to go, oh, we screwed up big time. Let's go back to the gold standard, and just some Sunday night they just announce it, that henceforth the dollar is just it's just a name for 1/10,000th of an ounce of gold. And then on Monday, the economy starts over with a sustainable monetary system. That would be the best case scenario, and it's also the least likely scenario because it would be the smartest thing for the government to do. And it's been a long time since those guys did the smart thing when it comes to money.
Should politicians have to pass an IQ test?
Well, voters and politicians maybe should have to, but I think that the point of the Constitution in the U.S. was to limit the power of governments such that even stupid people in office couldn't do too much damage. And we've gotten so far beyond the bounds of the Constitution now that stupid people in office can actually do a lot of damage. So the IQ test thing, I get the point of it, but I don't think it's practicable. I think what would have to be done is we have to go back to some strict limits on the power of government. And in that way, people still get to vote for who they want to get to vote for or want to vote for. But once in office, there's a limited range of damage that those guys can do.
I was going to say all an IQ test would do is give you a smarter group of manipulators.
Yeah, you make the case that in today's world, you don't want smart sociopaths in charge, right? But I kind of think in a lot of cases that's what we have, like the deep state in the U.S. You can't say that our government, our elected government, is always high IQ, but the deep state, the entrenched bureaucracy, is made up of mostly very smart people with a lot of sociopaths mixed into the stew. And that's a dangerous combination. If you give a smart sociopath unlimited power, you get a dictatorship. And we're kind of sort of doing that right now. If you look at the ability that the NSA and the CIA have now to basically vacuum up every electronic communication that anybody makes in the world and then store it forever to go back through it anytime they want to. That gives them an insane amount of power because anybody that crosses them can get a phone call from somebody at the CIA or the NSA, and they say, hey, in this email that you sent back in 1998, that looks like you were cheating on your spouse, and on this other one, it looks like you're cheating on your taxes. Do you want these to go public, or do you want to do what you're told from now on? And a lot of people will do what they're told. So that is just way too much power for the government to have, even if they make the case that they're going to stop terrorist attacks or something like that with all this information. The reason we don't give the police unlimited power just as the normal course of life is because, yes, they would catch a lot of criminals, but then they would become the criminals after a certain point because they'd be corrupted by all that power. And it's the same thing with what we're doing with the government now, especially in the U.S., but all around the world. There's the Five Eyes agreement through which a bunch of allied countries in the West spy on each other's people and then share what they get among themselves. So the U.S. can say, oh, we don't spy on Americans, but you know what? Maybe the Australians do, or maybe the Brits do. And then they share that information with us. And then the Brits and the Australians say, oh, we don't spy on our people, but the U.S. spies on their people and then shares that information. This is actually, if you want to know more about this, Edward Snowden's autobiography just came out. Great book, written by a guy who's, first of all, a genius. Second of all, very cool. He seems like a good person who's really grappling with a lot of this stuff, and he understands the technical side of the surveillance state. So that's a book that you should definitely read, and I guarantee you by the end of it, you'll be terrified at what these guys can get away with.
And maybe pay cash for it instead of using your credit or debit card.
You know what? Not a bad idea, because that goes down as part of your permanent record. Why are you reading the book of this traitor? Do you want to become a traitor yourself? Do you work for the Russians? That's the kind of thing that we're looking at now when stuff like that turns up in our Amazon accounts. So yes, buy Edward Snowden's book for cash, or borrow a friend's book version of it, whatever. But yeah, don't charge it.
John, thank you so much for being on This Week in Money.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Coming up, Wolf Richter, next on This Week in Money.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to This Week in Money, Wolf.
Thanks for having me back, Jim.
Wolf, economists and central banks have been complaining about inflation, that it's not going too high, but that it's running too low. But for lots of folks who work for a living, there's plenty of inflation. In terms of new and used cars, what does this so-called low inflation environment look like?
And so you would be astounded to know that the consumer price index, the sub-index for new cars, has been essentially flat for the last 25 years. And so no inflation in new cars. And that the consumer price index, and that's in the United States, for used cars has actually declined, so that there is deflation in used cars since the mid-90s, over the past 25 years. And so you ask yourself, how is it even possible? Back then, I could buy decent used cars for a couple of $1,000s. Now, I have to pay $15,000 to get one. And so I looked at the prices of a Toyota Camry, so that's on the new vehicle side, and dug up some data going back into the 1990s. And so you could buy a Toyota Camry LE 4-cylinder in 1990 for around $14,500 US. And the current model of a 2019 model of a Camry LE 4-cylinder, the retail price is just under $25,000. So this is comparing retail price to retail price, so MSRP in the United States. And so this is a huge price gain, from $14,500 to nearly $25,000. From 1995, so that's 25 years. It's a little bit less, so it's from around $19,000 to nearly $25,000. So this is the price gain for an actual vehicle, new vehicle. And the consumer price index for new vehicles in the United States has been flat over that period. And so people have been saying this all along. I'm paying so much more every year for cars. What's going on? How come inflation doesn't pick up this number? And this is it's not that there's some cheating going on, and there might be, but back in the 90s, you got one airbag and that just came out in the 80s, 90s, and you got a 3-speed automatic transmission. And then gradually the equipment was upgraded. You got a 4-speed, and then there were 2 airbags, and then you got a 5-speed automatic, and there was 4 airbags. And today, you have like 10 airbags, and you have an 8-speed automatic, and some cars come with a 10-speed automatic, and they have all kinds of electronic equipment and things that you couldn't even dream about in the 1990s, such as backup cameras. When you put it in reverse, you have a little screen in your dashboard that shows what's right behind the car, so you don't run over your dog that's sleeping back there. And just numerous other practical things that these cars have that weren't part of it back then. And the way inflation works is the theory is that it's really it's a measure of purchasing power. So how many more dollars does it take over time to buy the same thing? And in cars, you can't buy the same thing. You cannot buy a new Camry that is like the Camry was in 1990. So that's impossible. So they subtract out the quality improvement the government does when they figure inflation. That's done everywhere now. And so anytime you go from a 5-speed to a 6-speed automatic transmission, that additional expense is taken out of the inflation calculation. And anytime you go and add another airbag, that's taken out. Anytime you add new electronic equipment, that's taken out. So you get to these situations where the cars are improving a lot every year. They're a lot better today than they were 30 years ago. But they're also getting a lot more expensive, but the additional expense is not picked up in inflation. So you have this, bizarre situation where, used car inflation has been negative for 20 years. And, which is just stunning when you think about it because, you're paying a lot more for used cars today than you did back then, but you're buying a lot better cars and they last longer. And, you buy a car today and you can drive for 200,000 miles and maybe longer. And we have a car that's got 140,000 miles on it. We bought it new. I mean, it looks good. There's no reason to get rid of it. It's got no problems. It's running fine. And people have the cars longer. So all this is figured into inflation, these quality improvements, and removed from it. So, in terms of the average transaction prices, so what people actually pay on average in the United States in US dollars, you're looking at a 22% price increase for new vehicles and an 18% price increase for used vehicles over the past 7 years. And that's a pretty good price increase. So for used cars, they went from around on average like $12,300, $12,000 in 2012. And now they're at $14,300 roughly on average. These are the average transaction prices that people actually are paying for them. And new vehicles that has moved from around $30,500 to close to $39,000. So $38,500, something like that today. So these are big price increases that we're seeing in the actual vehicles, and everybody knows it. Everybody that goes shopping for cars knows that they get more expensive every year. And by quite a bit. Now, the average transaction prices have been rising in the range of 3 to 6% a year for the last few years. And that is just not picked up in inflation. So we look at, you look at inflation of 2% or 1.7%, whatever the figure may be in the United States that we're at right now, and the CPI in Canada, it's a little higher. And, in reality, you pay 3, 4, 5% more for that new vehicle or that used vehicle, and that's just that's in dollars. You're getting a better product. You're paying for the additional equipment. You're paying for that extra gear in your automatic transmission that you didn't have last year, or the extra 2 airbags that you didn't have, or the side impact bars that keep you alive and safe in an accident. And so you're buying a much better product, but your inflation number doesn't match that. So when you think, okay, I have a certain amount of money invested, and it's making me $3 a year in return. 3% a year in return. You still cannot keep up with the actual price increases that you're facing. Because they're a lot higher. It's not necessarily inflation, it's quality improvement that you're paying for, but you can't buy the old stuff anymore. You can't buy the 1990 Camry today that's brand new. So you have to buy the improved equipment, but it costs you a lot more. And cars is one of the primary examples where they're getting very expensive and people are really struggling to pay for them because their wage increases kind of keep up with inflation as it's measured, but they do not keep up with all the price increases that come due to the quality improvements. And it goes for housing and it goes for other things too, and services where the quality improves and homes get nicer and have better appliances and so forth. That's all figured into the inflation index. So if you think that your salary goes up 2% a year on average for a country, and inflation is 2%, that you'll stay even, that's wrong. You'll fall behind because you cannot afford the quality improvements that are now becoming just standard in everything. And that's why we have the trouble in new vehicles in the United States. People bump into a price ceiling. They can't afford them anymore. They're stepping down into used vehicles, and even their prices are now very high. So volume is declining. It's how it works. And we really, when we talk about inflation and price increases, we need to distinguish between the part that's the decline in purchasing power of the dollar and the part that's a price increase because of quality improvement. But for the wage earner, it doesn't make any difference. The thing is 4% more expensive than it was a year ago. Suddenly it's moved out of range. And the industry is struggling with that, but of course everybody who's working in the lower half of the income scale, that's a real big issue right now.
Has there been any push by manufacturers to come out with a good, simple, plain car without all these electronic doodads, or do they feel they have to include them or people just won't buy them?
Yeah, so this would be a really interesting thing, because we had, in the past, we had some efforts, in that direction. And, in the United States, we tried to import the Yugos from Yugoslavia back in the 80s. And, those were bare bone cars and, very cheap, but just bare bones. And Americans refused to buy them. We like, nice cars and it's a very competitive environment. So some things are required. So all the safety features are required. You don't need to have 10 airbags, but a certain number of airbags are required. The side impact and the crumple zone and all these things that are built into cars now are standard. You can't really get away from that. And, it's important to save lives. I'm all for that. If you come up with new safety features that will save lives, I think that's great, especially passive safety features such as crumple zones and side impact, protection. I think that's really crucial. But, it's very tough to make money on a bare bones car, and it's very tough to sell them. The cheapest car in the United States, and that is new car that is sold, there's a few of them, but the Ford Fiesta is one of them, and they're selling in good numbers, but it's a very nice car. It's got the backup camera, it's got the electronics, and it's got all of that. You can buy it for $14,000. But that's a car that most Americans don't want to buy. It's too small for them, and it's it doesn't have enough power, and so you have this kind of consideration where everybody wants to buy a big vehicle with a powerful engine, so the manufacturers have been responding to that. Ford's making no money at all on that small car. And it's manufactured in Mexico, and so it doesn't involve any American labor. And, it's not a very profitable business to be in, a very tough business to sell basic cars. It just doesn't appeal to people.
We'll have more with Wolf Richter when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Wolf Richter. Wolf, when is the best time to buy a new car, and when is the best time to buy a used car?
So what I always say is this: there's a distinction between the financial point of view and the other point of views. So if you want to buy a vehicle to impress your significant other, or an employer or whatever, or client, then these are reasons to do that when you need to do that. When it comes to financial reasons, my advice always is you don't buy a vehicle until you need one. And you want to delay that, because the longer you drive a vehicle, that doesn't cause you problems. If the vehicle holds up and it doesn't require repairs, the longer you drive it, the cheaper it gets for you. And so the best time to buy a vehicle is to wait as long as you can. And then, you really, for new vehicles, you want to buy when there's a glut. And I don't mean a glut overall, but in that particular vehicle type. So if you want to buy a car, a four-door sedan, mid-size four-door sedan, there was a time a couple of years ago, when the manufacturers here really had trouble selling them, and there was a glut of these cars. And by now they have shut down the plants. The layoffs have rippled through the industry. They've shut down plants. They've gotten rid of the car lines. They've trimmed that down, so that glut has gone away. But back then there was a glut of four-door sedans. There was huge incentives on it, and dealers needed to get rid of them. And there's lots of good deals being made on them. And then conversely, in the used vehicle market, they pushed down prices. So that was a good time to do that. But you don't really want to buy a car when there's a glut unless you need a car financially. If you need a car, that's not necessarily the time that there's a glut. There's a timing problem there. And in terms of trucks, that's been very popular for a long time, and SUVs. So there really isn't much of a glut. Some of the luxury vehicles on the SUV side, there might be a little bit of a problem. So you go by manufacturer. You're looking at what Ford and GM is doing, what Nissan is doing, what's on the dealer lot. If there started to be a lot of inventory and you see vehicles that have been there for a year, that's a good time to buy. They still will make you a deal. It's not necessarily what the manufacturer will offer you. It's what the dealer will offer you. And when there's a glut in a particular vehicle line, that's the time to buy that line. And you need to find out locally when that is. And there's some times of the year when it's a little bit better and a little bit worse, but it is much more dependent on what's on the dealer lot, what the dealer is struggling to get rid of, and what the manufacturer is struggling to get rid of, and so it's less of a calendar issue, because you're not buying the average car. So we're using average prices, there is a seasonality to average prices, but you're not buying the average car, you're buying just one of them. And then you're looking at other issues that transcend the seasonality. And, so you need to just look what vehicle lines are in a glut, and then pick a dealer that's drowning in inventory and find something that's been sitting on the lot for many months. And you can see that on the inspection sticker and maybe some other signs that if the vehicle hasn't been really taken care of, there'll be some dirt on it and some other things. So you can see that a little bit. And then go jump on it and just really work the dealer and be ready to stand up and walk out and tell them you're going to finance and don't negotiate the payment, but negotiate the price. And if they rip you off on the payment, then pay off the loan the next day. And so there's tactics that you can use to get the best price that far transcend the advantages of trying to wait for the right season. And so I think that you start with the dealer and you look around at the incentives on the internet and try to find out what product line is in a glut, and then you try to go after that.
Is it necessary to go through a car dealership, or should you look at car brokers who offer to sell, $200 above invoice, something like that, but you don't get any accompanying deals, or maybe you can get free servicing for a year?
Yeah, I don't really know how that is legally structured in Canada. I know in the United States, you will end up having to take physical delivery of your car at a dealer. So you can quote unquote buy it on the internet, but the actual purchase takes place at the dealer, and it's regulated by franchise law at the state level. And that is a tightly protected law, and so you can't buy a car on the internet and have them ship it to you and take delivery at your house. And maybe there's a dealer involved. There has to be a dealer involved. And so the broker is just another layer between you and the dealer. And the broker needs to be paid too. So I think you can get the same or better deals if you really work the dealer than trying to go through other organizations. On the other hand, I think it's crucial to do your research on the internet and to compare prices. And if you find a price on the internet and you can lock it in at a dealer, I think that's a good idea, and see whether they will actually sell you the car for that price. A lot of times, they'll have a car on the internet and you go there to buy it and take delivery of it, and they don't have it, and they'll say, well, you have to have $500 more to buy this car over here. It's a different one, and so you want to be careful with that, but the fewer middlemen you can involve, generally, I think better. And at the same time, in the United States, you cannot buy directly from the manufacturer. Tesla's got that problem. It was able to, because Tesla doesn't have any franchise dealers, so these stores it has are factory stores, and they violated franchise laws. And so some states accommodated them, and other states didn't. So you have plenty of states in the United States where Tesla doesn't have a store yet. And in other states, like in California, it's no problem. So Tesla was able to get around some of these rules in that it has no dealers at all. And so it started with a fresh sheet of paper, but a manufacturer that has dealers in that state cannot sell behind the back of its dealers. That's illegal, and it can't do that.
Wolf, the Swiss National Bank is a big holder of U.S. stocks. What's it up to?
Yeah, the Swiss National Bank, we don't really know what it holds except what it discloses to the Security Exchange Commission in the United States. So it's required to disclose its holdings of U.S. traded stocks to the SEC. And so that's the one thing we know. We don't know what European stocks it holds. We don't know what bonds it holds, and it keeps all those things secret. So it holds 2,500 U.S. stocks, and out of about 3,500. So it has a very broad portfolio. It just came out with its latest third quarterly report, 13F, and with the SEC. And it has $92 billion in your stock holdings on it, a record. And the way it does this is it essentially creates Swiss francs. It converts them into dollars, and it then uses these dollars to buy stocks. And the purpose, ostensibly, it's trying to depress the value of the Swiss franc, and by watering the Swiss franc down and selling it, and creating it, and it's a form of quantitative easing, but it's not buying Swiss assets with that. At least it may be, but it's not disclosing it. It's buying U.S. stocks with it in order to repress the currency. The reason it can do that is because the Swiss franc has a huge international demand. It's a tiny currency, a minuscule little currency, and there's a lot of demand for it. So it drives up the price of the currency compared to other currencies. And, there's hedge funds betting on it, and other currency speculators, and there are people looking at it as a safe haven currency, and, there are people having it on the mattress and whatnot. And so the Swiss National Bank is taking advantage of this fever, to buy its currency. And so it's selling it. It's creating it and it's selling it. And, in order to keep it roughly level with the euro and the US dollar. And this works as long as there is a large amount of demand for it. And as soon as the demand dries up, it can't do that anymore, or it will destroy the currency. And that is happening in other countries too. They've sold too much of the currency, watered it down too much, and suddenly you've got a decline in the currency that is dangerous to the country. And when it gets out of hand, when it spirals down, like in Argentina and other places, you have a collapse of the currency that impacts the whole entire economy. So it's a very risky a game to play. And obviously they know how to do this. They're very good at it. But at the same time, they're building this huge stock portfolio. They're not stock pickers. They buy anything and everything. So I went through this list of 2,500 stocks, and I did a little bit of data sorting on it. And they have at the bottom of it, so when you look at the positions in terms of value, they have a whole bunch of stocks on that list that have collapsed. And so my theory is that I buy stuff and they just keep hanging on to it until they fall off on their own, and they might sell a few positions, but the bottom end of that list is just full of dead garbage. And, just penny stocks, that IPOs from 2 years ago that collapsed, and, stuff that, no prudent investor would have touched with a 10-foot pole they've got in their portfolio, and obvious, harebrained schemes and scams, and they still have them, and they are the worst, nothing and next to nothing, and 95 cents a share, whatever, and it was, $40, $50 a share a year ago, and so there's no effort to pick stocks. It's just kind of a random sort of process. When they need to sell francs, they create francs, they sell it for dollars, and they buy securities with them. And they do the same thing with euros. We don't have any insight into it because it doesn't disclose that. But obviously their trade relationships are with Eurozone countries around them. So Germany, Austria, Italy, and they're all in the euro. So it's trying to maintain a stable relationship with the euro. The European Central Bank is trying to water down the euro to improve its trade position. So it has been doing zero interest rates and negative interest rates and QE2 to cut the level down. And Switzerland is trying to keep its Swiss franc in line with that. And so you have this currency positioning here going on. This sort of currency war that they're doing. I can't call it that, but that's really what it is. And the entire world seems to be playing along because there continues to be huge demand for Swiss francs. And as soon as that demand dries up, they can't do that. They have to turn around and sell those US assets, to turn them into dollars, sell the dollars, buy francs with them, and to prop up the franc. So when demand dries up for the Swiss franc, they'll have to turn around this thing, and they have plenty of assets to sell. So it's not like they will let the Swiss franc collapse. That's not going to happen. But this whole theory is based on this endless demand for this tiny currency, and they're using it to their advantage. And I call it a racket. That's really what it is. And if the hedge funds stop playing along, they're going to have to stop doing it.
Wolf, can you tell us a little bit about Wolf Street?
WolfStreet.com is just about finance and business. I also have a podcast, the Wolf Street Report, and everything is free, and we have a very vibrant comment section with hundreds of comments oftentimes, and so come check us out.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of WolfStreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Wolf Richter, and thank you for listening. If you have any questions for our guests or for the show, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. I'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, it's always great to be on the show, Jim.
Larry, news release earlier in the week with some pretty good news about purity. Can you tell us about it?
They were very exciting, Jim. We had 99.98% purity. That's a record for purity for the company. I can't begin to explain how pleased I am.
And did it receive a lot of publicity?
Yes, it did. Matter of fact, even Bloomberg reported the press release, which is, they've interviewed us in the past, but it's nice to see that they thought it was significant enough to put out to the readers. And actually, we've had probably 6 or 7 reprints of the press release. It went out with peer publications and even with a couple of mining publications. And most importantly, we're starting to come to the attention of the actual green environmental, I guess you'd call them broadcasts, or you could call them newsletters. Very interested in what we were doing, which is a big step up for us. That's where we want to be. And so I can only say that I'm really happy about it, Jim. The other things that I'd like to talk about are some of the things that have come up. One is the question about what the recoveries were. We kind of covered that off. We have a proprietary method of separating the cathode material from the aluminum foil, and if it's got to have a certain shape to it, which optimizes our recovery. And if it doesn't have that shape, for example, if it's long and thin like spaghetti, or just real thin strips, that really creates a problem for recovery, because you get folding of the aluminum, and the hydrometallurgy is not able to touch that because it's folded over, and the surface isn't there to get the cathode material off. So the recoveries are, I think we reported recoveries of 84 and 88% in an earlier release, and so it was more important that we nail down the purity, because that's a big interest to any battery manufacturer. So we've been able to prove that we've done that. And I'm hoping to get another release out next week on the other tier 1 company and the results. So that's Cametco's busy working on all of those things. We've had quite a few conference calls. I think our biggest one day was 5, and so it's really hard to get back to people as quickly as we'd like, because a conference call can run anywhere, usually not less than an hour, and but that shows the interest that's out there. We're excited. And as you can tell by listening to me, that I'm still excited about it. The stock has been trading decently. A lot of selling by anonymous, so I'll let you draw your own picture on that one. And but we are moving ahead with everything, and I want to remind everybody that we've already proven that the pilot plant works. We haven't announced anything on lithium because the lithium is a proprietary area which we are going to apply for a patent on. So that'll come at some other later date. But the fact that we've been able to deal with the product is great. And I'm looking at another letter that came out. We're not mentioned in it, but it's e-scrap news, and where they say, battery troubles go beyond collection. They even talk about the profitability may not be there. I think we've shown that the profitability can be there with the larger battery packs, which is in the EV cars. And, of course, scraps, which is, which really makes us levitate. The scrap material is one of the things that we want to do initially so that we can show a profit, get some money together to move into the next phase, which would be full battery battery treatment, shredding, and then, of course, our hydrometallurgical process. I'd like to remind everybody that we do have an initiative going on with the Department of Energy labs on actually preparing or dismantling the batteries so that you get down to the foils so that you can work on them. And so, we'll have first shot at being able to patent that once it's all done. And we will definitely follow up on that. But currently, I really like the solution that that the Netherlands has, and that is with Better Safety Solutions, BSS, because they can shred a battery and take it down to a point where we can get high recoveries and high purity out of them. So we've tested some of their material. They have a novel approach to it, and we think that that will definitely be a part of our answer going forward. We'd like to have our own shredding opportunity, but that may take a little time. You got to remember that the most important thing of the whole process is being able to treat the cathode material and get high recoveries in the 90 to 100% range, and purities greater than 99.5. And so we're working away at that. One of the things that they talk about out there is the price of cobalt. So I've attached a few articles to the podcast today. And the price of cobalt has gone up almost 50% for battery grade. And I think it's around 24% for the ordinary cobalt, the price. So that's really great in our ballpark. And, which puts us up there, we can make a profit at the low end of the scale. That's the one we've been using all along. We have never used the battery grade one. And, but sometime when we're cutting deals and everything like that, that's the price we will be using. And, maybe get a little discount from that. I don't know. There's a lot of things to worry about. One of the articles I attached talks about the smaller batteries that go into appliances, or not necessarily appliances, but laptops and cell phones and all those things. There's got to be a way of getting them out. And I agree. These companies are putting them in; they glue them in, so you can't just go in and slide them out like we used to and change the battery on our cell phone. They're stationary in there, and that creates a problem for the recyclers. But I like the Better Battery Solutions. Their method of shredding and treating the material would allow them to work on these types of devices. But I think that the industry has to standardize that, make the batteries more obtainable, so that we can get the high contents of cobalt and everything out of them, because they do contain, a lot of cobalt. Most of them are lithium cobalt batteries. And so we've, taken a broad look at the future out there. We've developed a process. It is a circular economy. We have a closed circuit process where nothing goes back into the atmosphere. The water is reused. And it's the answer, I think, for going forward, because these EV companies and all that all want to be compliant with the environment. And we've got a solution for them. So, and that's starting to show itself. We're getting that type of interest out there. So, it's been a great week.
Larry, for people new to American Manganese, what are you all about?
Well, American Manganese is a critical metals company that developed a process back in started in 2009 and was patented in 2012 for treating very low grades of manganese, which U.S. is prolific in. And, of course, manganese is the second highest critical metal on the charts out there. The old saying is that if you can't make steel without manganese, and if you can't make steel, the world stops, and that still stands today. You need that manganese in steel production, so you get the ductability and you get the strength. So manganese is essential. There's no substitution for it. So we developed a process that was patented and that we could work with 2 or 3% grades and compete on costs with China. We're only waiting for the overhang in the Chinese markets so that we can turn the page and say maybe we should look at the old pre-feasibility study we did on it and reactivate that, probably with a partner. So we took that process at Cametco's behest and developed a process for treating cathode materials in which we got high recoveries and high purity, and we patented that. We felt like we may be in a race because everybody was talking about recycling, but at that time nobody was doing a lot about it. And but there were companies out there that were moving ahead with recycling, but they were looking at different solutions than we were. And now we've got a process out there that should be very marketable, and we would like to get our pilot plant, or not our pilot plant, our commercial plant started next year. So American Manganese is traded on the Toronto Stock Exchange Venture under the symbol AMY. It's traded in the U.S. under the symbol AMYZF. Traded in Frankfurt under the symbol 2AM. We have a website, AmericanManganeseInc.com, where you can do all your due diligence. I get letters that that ask questions. It's already covered in that site, and then we also have the, of course, our phone number 778-574-4444, or you can email me at LREAUGH@AMYMN.com.
Larry, thanks for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on November 15th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.